Good evening. Welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Tonight is a pre-recorded show, and it's kind of shorting 101. Garth, welcome. You're going to be overseas at this point in time. So shorting has been a feature of the market in a very positive way for people who managed to get the short positions right, and also a very negative way when they got carried out by their shorts. So tonight we're going to be discussing shorting. So perhaps you want to start off for, I suppose, traders who are new to the game as to what exactly it is. Yes,
that's right. I'm often asked, what does shorting mean and what's the whole concept around shorting? Because it's for those who are not familiar with the trading territory, it is a little bit of an odd concept. It basically involves selling something that you don't own.
Yeah.
In order to take advantage of a price decline, which most people would say, but how can you sell something that you don't own? But you can. In the stock market world, it's a perfectly normal thing to do. It's a perfectly legal transaction to do, and it's something that we see very, very often. So just to kind of unpack the basics of what does shorting mean, but it's where you're taking a view that an asset's price will decline. That's the only time you'd really want to go short, is if you feel that something, a share or a currency or an index or whatever the underlying asset might be, you feel that that asset's price is going to decline. You look to sell the asset first, and then you buy it back, hopefully at a lower price later on. That's in an ideal world, and that's what you want your short to do. If you sell and then the market goes higher, well, then you're on the wrong side of that short position. Then you would end up buying back at a higher price than where you sold short, and that would imply that you lose money on a short position. So you want the share price or the asset price to decline in the case of shorting. And simply the timing of the buy and sell transaction are switched around. Now, just to get into the understanding and the mechanics of how this can actually happen, because again, I'm sure there are people out there saying, well, that's fine, but how can you sell?
How do you go about it?
Yeah, and also, how do you sell something that you don't own? So the way it typically works in the stock market world is that you would go and you'd actually borrow scrip, borrow shares. And typically you'll find that your long-term investors and your big institutions, the likes of pension funds and that sort of thing, that are long-term holders of shares, they don't ever plan to sell them. They're there for pretty much to buy and hold. What they will do on the side is they'll run a scrip lending desk where they will then lend out shares to people who want to go short, and they'll charge them a small fee for lending those shares. So let's say, for example, I want to go short of MTN. It's an example we're going to look at just now. I don't own any MTN shares, but I want to go short because I feel that, for a variety of reasons, the share price must go down. Now, what I would do is I then go along to one of these institutions or pension funds and say, hi there, can I please borrow 5,000 shares of MTN? I want to go short. They would say, that's fine, here you go. They'll lend them to me. I then take those borrowed shares and then I go and sell them into the market. When I sell those shares into the market, I actually receive money into my account for selling the shares that I never owned in the first place. I can then go and put that money on deposit and earn interest on it while I wait for the market to do its thing. I hope that the market or the share price will go down. If it does, then that's perfect. Then what I'll do is at a later stage, I'll then buy back those shares that I sold initially at a higher price. I buy them back at a lower price, and then take those 5,000 shares, go back to the pension fund and say, thanks very much, you can have them back now. And the difference between where I sell and where I buy back is my profit on that short position.
Okay, I mean, and what if you're using your online trading portal, which is what most of the retail investors do? Essentially, your banker's going to be the intermediary there, isn't it?
Yes, that's right. I mean, I've explained the mechanics behind how it all works and the scrip lending and borrowing process and so on. It's far more seamless if you're a front-end user of the market, and particularly if you trade a product like a CFD or a single stock future, where it's pretty much seamless. You don't have to worry about all that's going on in the background. Yes, your market maker or your CFD provider will do all of that work in the background for you, but you don't really need to bother with it. All you do is go onto your platform, and you've got an option to buy or an option to sell. And if you want to sell, you just hit sell.
Yeah.
And that's it. And then you go short. It's really simple. And it's the same as buying expecting the price to go up, except that you're selling expecting the price to go down, and the timing of your buy and sell transaction is switched around.
Yeah. Okay, well, show us an example of a successful short, because they can be very successful. Yeah. They can also be spectacularly unsuccessful.
Yes. So here's MTN, and this was looking at the trading action towards the end of last year in particular. And what we had noticed is that the share price was trending down. There was a lot of weakness, and it made these consolidation type patterns. So there you had a rising wedge, which ultimately broke to the downside. Then here you had another rising wedge, which also eventually broke to the downside. And these are bearish continuation patterns within a downtrend, and they do typically break to the downside. So what you would look at here, for example, is on that rising wedge there, that one that I've highlighted, you would look to short a breakdown below 138 Rand on the expectation then that the price is likely to go back and retest its prior low.
Okay.
So you're selling short on the break underneath the bottom of that wedge structure at 138 Rand. You're looking for it to come back down here to 123. So 15 Rand per share is the difference effectively, and that was the prior low. Now, if that worked, which it did in this case, then your profit would be 138 Rand where you sold, minus 123 Rand where you bought back that short, and therefore you've made 15 Rand per share. So and that's a successful short.
And if you were leveraged, then it gets a whole lot better looking.
Well, leverage implies that you not put up the full value of this transaction, you've only put up margin to do this trade. And that introduces the concept of leverage, because you can then, and CFDs give you that ability to take a leveraged exposure.
Okay, so that was a successful trade and was one for the portfolio.
Yeah.
Let's talk us through an unsuccessful trade.
Yeah, so this is an unsuccessful trade in African Rainbow Minerals. I know of a few people that were burnt on this short trade recently. I also lost a little bit of money trying to short it as well, but fortunately nothing too serious. But what I looked at here was that we've got this downtrend which goes back all the way to 2014, and that downtrend was fairly firm. You get this massive rally that goes from all the way down like 30 Rand a share or something up to recently about 70 Rand a share over there. And you would say, well, gee, after a move like that, you would think that it's going to run into that resistance and fail and probably come back down and succumb to a bit of profit taking. But it didn't. It actually carried on going higher. But let's assume you had gone short at that downtrend at 70 Rand, expecting the price to decline after that. Mm-hmm. It didn't decline. As you can see, it continued to rally, and it rallied very, very hard, actually. And it got to 115 Rand just 2 weeks later. So if we assume that you would have gone short at 70 Rand and then didn't close it out quick enough and only managed to eventually get squeezed out up at the top here at 115 Rand, well then your loss would be the 70 Rand per share where you sold short minus the 115 Rand per share where you bought back. Okay, so that's minus 45 Rand per share. That's what you would have lost if you would have been short without a stop loss there from the point of that break of the downtrend up to the recent high.
And to some extent, it's a self-fulfilling prophecy, because you talk about a squeeze, and we blithely use the expression short squeeze, but some people might not be that familiar with it. And there was one example in the market recently of where that happened, and that was Kumba Iron Ore. Perhaps you can tell us how a squeeze takes place.
Yeah, a short squeeze is where the market is very much stacked to one side, and there's an excessive number of short positions. And remember, the thing about being short is that there's no limit to how high a share can go. If you buy a share, the worst that it can do is go to naught. If you short a share, well, it could go to infinity. So that's the problem, and that's one of the dangers of being short. Okay. And if a vast number of people are caught short at the same time, and they all start to lose money, well, then they're going to need to buy back in order to stop the pain, as it were, on that short position. And that, if you get a vast number of people all buying back their shorts at the same time, that's what we refer to as a short squeeze. And it did happen on Kumba Iron Ore recently. So let's have a quick look here. Here, this stock has been very bearish for a number of years. It's gone from 600 Rand down to 30 Rand recently. So it's lost 95% of its market capitalization. But from the bottom in January to the recent high, it's also rallied 350%. So it's been a very, very violent move to the upside. So if the first clue, I guess, that maybe the downtrend was really broken was when you started to see this share price making the first higher low and actually a higher high in that case. That indicated that this break of the downtrend was for real, and now that bearish action has actually now started to turn to the upside. That would have caught a lot of people short once it started to move up like that. And therefore, you saw this price just climbing and climbing and climbing. And there were fundamental reasons for that. The iron ore price has been moving higher. Other commodity prices have been moving higher. So you would have had a bit of natural buying of the stock, which pushes the price up. But also, because the short interest is fairly high, that also means that the shorts have to buy back to avoid any further losses. So you've got two, a double whammy effectively of buying forces, the natural buying as well as the short covering, and that takes the price higher. And it implies that there's basically a lack of sellers around. Now, what we saw about 2 weeks ago was this share price was up 35% in one day. And that's your short squeeze over there. And it happened on fairly elevated volume as well, slightly larger than normal volume. When you see a move like that, that move, you can guarantee that would have hurt a lot of short positions. And it didn't go higher than that. So subsequently, it's been pulling back now. So the squeeze always happens at the end.
And it's very aggressive. But that's not even the worst sort of, or the magnitude of that isn't anything compared to a short squeeze that you're going to show us now, and that's in Volkswagen. Talk us through that one.
Yeah, I've called it the most memorable short squeeze in history. I'm not sure whether it was the biggest short squeeze in history. It might have been, but certainly for me, the most memorable. And this happened back in 2008. So there you've got a share price chart of Volkswagen, and it goes back all the way to 2004. So we're looking at a lot of history here. But that very, very violent spike that we saw towards the end of 2008 there was the result of a very violent short squeeze that happened in the shares of Volkswagen. And we saw that price go from 200 euros up to over 900 euros in a matter of a couple of days. And the result, or the reason for that, was that Porsche they've always owned a big shareholding in Volkswagen, but they had somewhere along the line said that they weren't planning to increase their stake in Volkswagen. But meanwhile, behind the scenes, they actually did increase their stake in Volkswagen. And then through the options market, they had options to take up a whole lot of extra shares in Volkswagen. And those options were in the money. So you ended up with a situation where Porsche owned 74% of the issued shares, or had right indirectly to own 74% of the shares in Volkswagen. A group called Saxony had right to owned the other another 20%, which meant that there was only 6% of the company that was actually free float traded in the market. But there were 13% of Volkswagen's issued share capital was out on loan to short sellers. So what it meant was that it was virtually impossible for the short sellers to actually buy back their shorts. And that was what resulted in a massive short squeeze. And billions of dollars and euros were lost on the short squeeze in Volkswagen that year.
I suppose if you've ever had a bad trading day, just remember that. It
Yes.
could always be worse.
It could always be worse. This is the most memorable short squeeze that I can think of.
Gosh, so, I mean, maybe just to sum up, a couple of pointers then, if you are going to go short.
Yeah, there's a couple of things, because always remember, look, it's a useful strategy to use in a bearish market environment. But you have to remember what I said, is that when you go short, understand that there's no limit to how high a share price can go. And for that reason, it does require an extra level of risk management and acknowledgement of the risks if you're going to go short. So I've got 4 bullet points there just to keep in mind, and they're quite useful ones to remember. It's safer to short a weak stock in a downtrend. In other words, you're trading with the momentum in that case. You don't want to be trying to short strong stocks and shorting, picking tops, as it were. There's no limit to how high an asset's price can rise. So for that reason, stop losses are absolutely imperative. Be very careful of shorting tightly held stocks. So the example of Volkswagen, it was a very tightly held stock. Kumba Iron Ore is also a tightly held stock by virtue of the fact that Anglo American owns a big slug of it. And there are other tightly held shares on our market as well. So be careful of shorting tightly held stocks, because they can be very prone to a short squeeze. And then the last point is that be very careful of picking tops. What goes up does not necessarily have to come down.
And I certainly get a lot of questions saying, oh, it's got so high, it must fall.
Yeah.
No.
It doesn't have to.
Yeah.
And there's no limit to how high a share price can go. And I mean, that African Rainbow Minerals example that we looked at is a case in point. I thought was gone up, it touched resistance. You would think it's got to come down a bit. But it didn't. It rallied another 60, 70, 80% after that. So, be careful of picking tops.
Okay, Garth, we have to leave it there. Very interesting discussion. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.